if we take a step back and we're looking at those economies where we have seen the biggest downward revisions within Asia, and I think, of course, outside the noise that comes from new data releases that happened between our November and our January baseline forecasting round, it's economies like Thailand, Singapore, Taiwan, and those downward revisions are coming from the fact that exports are a relatively larger share of the economy, and global trade is expected to have a tougher run in 2025 and 2026 with these tariffs. And then, there is that additional hit to those that have a particularly large exposure to the US market. So again, that's Thailand and Singapore. But I think for other economies, across Asia Pacific that we don't have on here, like Philippines, Indonesia, and India, which we will talk in more detail later, I mean, there hasn't been the meaningful changes to our forecasts from tariff assumptions because these economies are more domestically driven. And what we've seen from these economies is that there has been a particular domestic resilience, particularly from places like India. So, we're just not seeing those downward revisions in the forecast. And, the one additional point I'll make is that if we are looking at trade ties across Southeast Asia over the past decade, the region has really become more tied with both China and the US. So while there was the view back in the first Trump presidency that places like Vietnam and Thailand benefited from the relocation of US trade away from China, these economies are still hit from a weaker China on the other side of the coin, given their closer trade linkages over the past decade. And I think that ties into some of the questions that we've got through the chat as we've been speaking, that it's not just a case of being able to relocate trade to other areas to circumvent tariffs. And I think that, Trump is certainly more aware this time around that, for instance, Vietnam almost became the poster child for benefiting from trade relocation away from China, but we just don't think that that's going to be the case this time around. And also keeping in mind that Vietnam, its trade ties are so closely interwoven with China as well as the US. But if we move on to the next chart, looking at specifically currency movements. Now, one of the questions that we did receive in advance of this webinar is whether Trump will actually impact Asia's currencies. And I think, the impact is already happening in real time, and we can see that quite clearly on this chart. I mean, what we've seen is that the greenback has strengthened quite a bit since November, and part of this has been on the back of a Trump win. The idea being that his policies will be more inflationary than the alternative, so it means fewer rate cuts through this year. It will also be, a more volatile period for global trade, so there is that additional attractiveness in the greenback as a haven asset. But what we can see on this chart is a time series of several Asian currencies against the USD and how they've moved since 2021. Now, interestingly, the dollar has lost a bit of ground over the past day or so, and emerging currencies in Asia, especially China, actually got some reprieve in Asia, given that China wasn't kind of seen as high on the tariff hit list or policy priorities at this stage. But I mean, when we're looking at this chart, I mean, it's a little counterintuitive, but what we can see is that depreciation results in a higher value on the graph. Now, currency depreciation and volatility, they matter for APAC from an export competitiveness point of view, but also from an inflation and monetary policy perspective. So while there is that obvious trade impact via tariffs that Steve's mentioned for Asia, I would say that we can't forget about the currency impact, and that can be, a real subtle impact over time, but still just as pervasive. Now, what stands out, of course, on this chart is the yen, and I won't steal Stefan's thunder when he's talking about Japan, but what I will just say an introductory remark because it deserves a comment. The yen's depreciation is certainly not just a US Trump inflation story. There's more at play here, particularly on Japan-specific factors. And this is to the point where the Bank of Japan is hiking rates, likely even further this week, in a bid to stamp out some of the yen depreciation that's happening, even against a backdrop of a weak economy. Now, the next currency that's experienced some significant depreciation against the greenback, but also, on a trade-weighted basis as well, is the Korean won. And, the domestic political calamity has really accelerated the existing downward pressure on the currency, and it really does exemplify the role that an unstable domestic situation can play on a currency that's already under pressure. Now, the problem is that the Bank of Korea is easing rates to lift sluggish domestic demand, but the problem is that with consumer and business sentiment already taking a hit from the political situation, rate cuts are lacking that potency to really reinvigorate household spending and business investment. Now, the rest of the currencies from China, Taiwan, Indonesia, India, the depreciation is less pronounced, but we do know that central banks do have are watching their currencies with an incredibly close eye. And I think Bank Indonesia, it's an interesting case here. Now, the rupiah is represented by that dark pink line. Now, typically when we see currency weakness, Bank Indonesia is very clear on how it uses monetary policy and other interventions explicitly for FX stability. But nevertheless, despite this weakness, BI felt comfortable prioritizing the domestic economy and actually delivered a surprise rate cut earlier in January. Now, we do expect further easing in the first half of this year. So that kind of gives a nice precursor that while this currency depreciation is happening, it's not to a point where central banks are materially stepping back from the easing bias that most of them have flagged that they do have. Now, China is an interesting case. They've got obviously a lot going on, and Harry's going to talk about that shortly. But when it comes to managing currency against a backdrop of a weak domestic economy, we've got the PBOC, they've got that easing bias, and they've got that easing bias at the same time of not wanting to exemplify downward pressure on their currency. And we have seen that they have actually taken some steps to shore up its value by various measures, things like bond issuance. And I think that's going to continue to remain a theme as that policy support, particularly on the monetary and also fiscal side, continues to come through this year.